Hi, I'm Frank, and you're on the Money Cup channel. Today we're going to talk about a topic that some of you may be familiar with, but for beginners it might be helpful. We're talking about ETFs. What is an ETF? As the three letters suggest, ETF stands for Exchange Traded Fund. It's a financial invention that came about in 1989 to give small investors access to trading indices. In New York, we have four major indices: the Dow Jones Industrial, which consists of 30 stocks, each with its own weight; the S&P 500, which has 500 stocks across all sectors and is considered the most representative index of the U.S. economy; the NASDAQ 100, which includes the 100 most important tech companies; and the Russell 2000, which covers 2,000 small-cap firms, also known as small caps. Each index is a weighted average of the stock prices that make up the index. Institutional and professional investors in the S&P 500 could buy futures, but smaller investors would need a lot of money to mimic the index by buying shares in the same proportions. To replicate the index, they would have needed hundreds of thousands of dollars. So, someone came up with the idea of creating an index accessible to small investors, which would have the same underlying stocks as the major index, in the same proportion. That's how the first ETFs, exchange-traded funds, came to be. They replicated the American stock market indices. The most well-known are the famous SPY and QQQ, which replicate the S&P 500 and the NASDAQ 100 indices, respectively. What do I want to tell you? The issuers of these ETFs are required to hold the actual stocks that make up the ETF in the same proportions they've published. However, this doesn't happen in real time every moment. They have most of the shares, but sometimes the proportions differ, which is why the price of an ETF fluctuates slightly compared to the index price on the larger market. As you may know, opportunists and arbitrageurs are quick to exploit any discrepancies. When there's a price difference, they buy one and sell the other. Since ETFs can also be shorted, small and even tiny investors can bet on the decline of the U.S. market. Currently, the SPY ETF is priced at 583, while the S&P 500 index is at 5,851. You'll notice that the SPY ETF is essentially 1/10 of the larger index and contains the same 500 stocks in the same proportions. There are now ETFs for specific sectors as well, like electric vehicles, which bundle various stocks from that sector and sell it as a package. There are even gold ETFs that hold either gold mines or physical gold. ETFs are essentially a mix of different stocks in various proportions. Over the past 10 to 15 years, the ETF market has exploded. To give you an idea, the three biggest issuers of these salamis, ETFs, are first BlackRock, which currently manages about $16 trillion. For context, the U.S. GDP is $22 trillion a year. BlackRock controls 35% of the ETF market, Vanguard holds 20%, and another famous ETF creator is State Street, which created the SPY ETF. What's new with these exchange-traded funds? We now have inverse ETFs, which rise when the index or stocks attached to them fall, and fall when those stocks rise. These products allow people to bet on market declines. If the market drops, you make money. If it goes up, you lose. This feature has attracted even more ETF buyers, and of course, as with any derivative product, because an ETF is still a derivative product, albeit backed by actual stocks, there are risks. What happens when leveraged ETFs are created? Leverage ETFs, or LETFs, let you buy stocks on margin. The most common are 3x leverage ETFs, meaning you put in 30% of the money and buy all the S&P 500 stocks with just 30% of the cost. As described in the prospectus, if those stocks rise by 1%, your investment will increase by 3%. But keep in mind, the reverse is also true. If the stocks fall by 1%, you'll lose 3%. Leverage ETFs offer the potential for huge and rapid gains, which increases trading volume. But you should know that most ETF issuers are betting against small investors. You might ask, how are they betting against us? It's simple. When you buy, they sell. This doesn't mean they're breaking the rules of the American stock market. They still follow all the necessary margin requirements to ensure that if you win and they lose, they can still pay you. However, in practice, small investors are often greedy and trade emotionally, meaning that the number of losers is almost always larger than the number of winners. You need to think of it in terms of the money lost, not just the number of people losing. If we could trade against the entire world on the stock market and had enough margin to sell when others buy and buy when they sell, we'd end up winning every day with a 100% success rate. Why? Because the stock market game isn't exactly zero-sum. It's influenced by interest rates, fees, and reaction times. The majority of losers outnumber winners every day. What other interesting ETFs have been created in the last 15 years? If you want to buy U.S. Treasury bonds, I recommend using the TLT ETF. This ETF, created by Barclays, is made up of bonds with maturities of up to 20 years. You'll see that when interest rates spike, like recently, the TLT drops significantly. But when rates are cut, like during the pandemic, TLT rises. For example, TLT was at 100 in 2020, went up to 169, started this year at 84, and is now 93. For those who want to invest in U.S. Treasuries without picking individual bonds, TLT is a very liquid ETF. ETFs have also increased market liquidity. Think about it. If I create an ETF with 5 stocks and someone buys and sells all of them simultaneously, it increases overall market liquidity. Many compare ETFs to mutual funds, but they aren't quite the same. With mutual funds, you can't sell shares unless you own them, and you only get the value at the end of the day. With ETFs, you get an updated price every second, and you can buy or sell as long as the underlying stocks are trading. ETFs are a market worth entering after thorough research. Find a sector that interests you and buy it. Be careful with short-selling ETFs. It can lead to massive losses. Avoid inverse ETFs if possible, but if you do buy them, make sure to sell and lock in profits. Don't be greedy with ETFs. They can bring spectacular profits, but also equally large losses. Usually it's best to buy indices. Learn what's inside that ETF before buying. Let's say you decide to invest in the U.S. stock market tomorrow. What's the safest bet? If you don't want to take any risks, buy U.S. Treasury bonds. If you want a little risk, get an ETF based on bonds. If you expect inflation, buy commodities like gold or wheat. If you want to take on more risk, buy an ETF on gold, wheat, or a mix of commodities. What else could happen? You may want to buy stocks. If you buy and hold stocks for 10 or 20 years, 90% of you will come out winners, some more, some less. If you pick stocks that produce something and generate profits, your chances of success over 10 or 20 years are very high. But until those gains show up in your bank account, you may face significant losses. Can you hold on to stocks if they lose 50% or 60% of their value? From my experience, 98% of people won't. Most will sell at a loss, especially if their stocks drop 20-30% in just a few months. Will you hold on to those stocks for 10 years without selling, even if they double or triple in value? The answer is, for 99% of people, no. Most investors sell quickly when they profit and don't sell at all when they're losing. But when the losses become unbearable, they sell everything, leave the stock market, and say they've been burned. No, you weren't burned. The American economy didn't collapse over a 10 to 20-year period, and even the Great Depression of 1929, which lasted a long time, eventually led to the huge economic boom of the 1950s and 60s. My advice is to read as much as possible beforehand. And if you decide to enter the stock market, start by buying a few shares with a small amount of money and see what happens. The first thing you'll test is your own psychology. Can you handle losing the next day? Can you endure when, after 3 days, your stocks are down 10 to 20%? If not, don't continue with the stock market. If you can watch my other videos to learn more about risks, short selling, ETFs, futures and options, and maybe even become a sophisticated investor. But you have to be ready to lose. Many people say they'll invest $10,000 and won't care if they lose it. But once they see $10,000 shrink to $6,000, it starts to matter. No matter how wealthy they are, they'll feel it. I'm sure you'll have many questions about this video, and I'll try to answer as many as possible. Until the next economics lesson, don't forget to like, share, and subscribe to the Money Cup channel.